Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Mark Giambrone, Portfolio Manager at Barrow, Hanley, to discuss election impact on the market and if the growth versus value cycle is overly extended. Mark, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Happy to be here.
And Mark, you know, the million-dollar question, is the market pricing in any discernible wins, and what could the potential impact be as we get through the election process?
Sure. I think at this point, the market's expectations are that we will get a blue wave, meaning that Joe Biden will win the presidency, the Senate will turn Democratic. Certainly, Biden winning is priced into the market, and I think a blue wave is probably mostly priced in. It's interesting to me because there are some policies, obviously, that would follow that wouldn't necessarily be positive for the market, like increases in tax rates, et cetera. But I think there's a euphoria around before those policies can come in place. What you'll see is a significant stimulus package, which the market definitely wants, and they think it'll be bigger under the Democratic Party. And I think a large infrastructure bill would be second, again, which would be good for stimulus, would be good for job creation. So there'll be this sort of euphoric period after the market, and I think after the election, which is why the market has been on a run here lately, even pricing in a blue wave. And they're willing to sort of take their medicine later, if that makes sense. So we'll worry about what comes after that in terms of potential economic policies that could impact earnings levels of the market.
Yeah, I mean, we really haven't had the opportunity to talk about policy, and it's not necessarily if a blue or red candidate gets in, it's the policy that's set that impacts the markets historically. Anyway, so let's talk a little bit about what's been performing. Do you think this value versus growth cycle is overextended at this point?
Well, we at Barrow Hanley, we are focused on the value side, so understand my bias, but it's the longest growth cycle we've had in the history of the markets. It reminds me a lot of 1999 and what's now referred to as the technology bubble. The market is very narrowly led, and so there are a few stocks that are leading the market, and those few stocks are the highest percentage of the overall market than we've had in history. It makes sense to me this in some ways with rates down very low, with COVID really being an attack per se. I mean, you're shutting down the economy to protect ourselves. However, that has a big economic impact. But there's a pull forward of demand, again, similar to the late 90s where we had the Y2K effect, if you remember. And now we had this work from home, pull forward with technology, and yet we're shutting down or forcing down a lot of the cyclical portions of the market. So it's really been a unique time and really a significant pull forward of demand for growth. We've seen that in the markets. So almost the more expensive you were or the bigger you were, the more technology related you were, the better you performed. The more economically sensitive you have been, the worse you performed. And in my mind, this is exactly what happened in the late 90s where you had this euphoric blow-off period of some of the tech and telecom names. And coming out of that period, you saw a reversal, which I do believe we'll have this time also, where value can make a significant comeback.
Right, and I agree, it is time to see some value participation so you have a more broad recovery, but it could also be argued that the stocks that are leading the way now, or let's say your modern day industrials, your new economy stocks, they do feel a little bit better than some of the ones that were leading in 1999. I mean, these are very different kinds of companies.
It's a very fair point, and I couldn't agree more. These are outstanding companies. When we talk about the FANGs, Apple, Microsoft, Amazon, Google, I mean, these are amazing businesses. However, there is a point at which the market tends to price in perfection. And if you look at Apple or Microsoft, we're talking about 40 and 50 times earnings. If you look at Amazon, we're talking about 90 times type earnings levels. And while I do agree those companies are better, great balance sheets, the market is currently paying for what I would call, certainty. So you're still going to use your Apple iPhone, and you and I are on Zoom, and we need a network and a background, and we need a computer, et cetera. And so we're getting a premium in the market at this moment for certainty, and we're obviously getting a discount for uncertainty. And all this revolves around where we are related to COVID and the potential for this to end and whether or not we'll get a healthcare solution. I think the reality is that there will be a healthcare solution someday. It's uncertain at the moment. Because of that level of uncertainty around, again, the cyclical names is at a significant discount, where the things that are more safe and certain are at a significant premium. It's my opinion, unlike most times in a recession, This was a forced shutdown, and therefore there's a potential panacea, which would be a healthcare solution that would then reverse us and allow us to reopen the economy and get back to our everyday lives. That will be very, very good for the value names. Every day that goes by, we get one day closer. It seems we have a lot of opportunity sets as we move into 2021 to have something meaningful happen. And when that happens, I think what the market will say is, okay, I was paying 50-ish or plus times earnings for certainty around companies that can grow 8 to 12%. Now I'm looking at these value companies that are a third or less of the multiple, and I can see a period of time where they can grow at a significant premium to 8 to 10% for a long period of time. Again, once we're more comfortable, things will go back to normal. And I think capital will flow then into those names. We'll see a significant reversal, and value again will have its day. Believe it or not, value does outperform. And when it does, it generally leads the market for about 7 years on average. And I think, again, if you look back to either the late 90s periods, kind of coming out of 2008, 2009 periods where value tend to lead, there are lots of similarities to what's happening in the market today to where we should be, where we were back then, and where we will be hopefully within a year from now.
All right, Mark, appreciate the insight. Thanks for joining us on Trade Talks.
Thank you so much.
All right, thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.